Good afternoon, everybody. Uneducated Economist here. A lot of these investment firms out there that have money market accounts, they're starting to waive their fees. They're waiving their fees on their money market accounts. Now, you know the money market accounts. These are it's like a lot of people have them at their banks. There's a lot of investment firms that have them. This is the very low risk, low yielding accounts that you can have as an investment. So if you have some cash, you don't quite know what to do with it, you don't want to tie it up long term, you can put it in a money market account, get a little bit of interest off of it, just a little bit better than a savings account. It's kind of like I mean, for simplistic purposes, it's kind of like an elaborate savings account. But these money market accounts, they pay such a low interest that the banks that handle these things, the investment firms that handle them, they have to waive the fees on them or else the accounts will go negative. And now I thought about this. It was just like, why would anybody even want one of these accounts? I mean, they don't pay anything. There's no real benefit for having one. But yet, the need for them in the economy is huge. This is where the short-term lending really starts getting its movement. Now, I mean, it starts up at the Federal Reserve and works its way through the banking system. But when it comes to short-term loans, money markets is where it's found. And it was back in the great financial crisis. It was the drawdown in money market accounts that started to freeze up the entire banking system, the entire financial system. Because it starts there. It starts at those money market accounts. And banks are dealing with the fact that interest rates are so low that these money market accounts don't really pay out much of an interest rate, and then when you put the fees on it, they go negative. So these banks have to waive the fees that they normally have on these money market accounts for handling this money. And now that they're waiving the fees, it's like, and there's no interest on the money. This is where negative interest rates really, or low interest rates, really starts to hurt the banking system. And this is why negative interest rates are going to be so detrimental to the entire banking system, is because it starts with stuff like this money market accounts. Because once those things go negative, or if they go negative, and you get no return on your money, and in turn actually have to pay to deposit in a money market account, everybody will pull their money out. And then the credit markets will start to freeze up again. You know, I think about this because, like, the Federal Reserve is doing a lot of what am I going to try and say here? A lot of tuning to their lending facilities. Because you think about this, the lending facilities that they have right now, these are the unusual and exigent circumstances tools that they get, and that they typically would not be able to use these lending facilities to help stimulate the economy during good times. But because of the unique situation that we're in right now, the Federal Reserve gets to use unusual and exigent circumstances, and that's where these lending facilities get to come in and play. These guys out here. But right now, these lending facilities are not playing up to potential, or at least I think the Federal Reserve's idea of potential. For example, this Main Street lending facility, you listen to this Main Street lending facility, and the sounds of the name itself sounds like, okay, you got like Wall Street and you got Main Street, like we're Main Street, that's Wall Street. But these Main Street lending facility, which is going to be getting loans to small businesses, small to mid-sized businesses, has been in operation for like 3 weeks, something like that, 3 or 4 weeks. And they've loaned out $14 million. That's it. Just $14 million. I mean, I bet you just setting up the facility costs more than $14 million. I'm just guessing. But you see what I'm getting at? $14 million, I mean, across the entire country during this recession doesn't seem like a lot of money. And some of their other lending facilities, they've had to expand the ability for people to apply. I forget how they worded it. Widen the possible applicants or something like that. I can't remember exactly how they worded it, but basically what they want to do is some of these other lending facilities, like the TALF and the commercial paper, the secondary corporate market. Those are like the corporate ETFs, the junk bonds. They want to be able to expand, and they're not wanting to. They are going to expand the ability for people to be able to acquire the loans from the Federal Reserve in order to purchase those things. Because the way these lending facilities work, and we've talked about this in the past, is that the Federal Reserve has set up a special purpose vehicle, which is like an entity separated from the Federal Reserve. It's like its own business. And they've loaned those special purpose vehicle entities, they've loaned those people money so that they can go in turn buy up the corporate ETFs or the corporate bonds or the, whatever. They pretty much got a lending facility for every single corner of the market. In fact, if you want to know a little bit more about the lending facilities, just go back a couple of weeks into my videos and you'll find where we talked pretty much about, I think, all of them. I'm pretty sure we covered all of them. And you can learn all about the different lending facilities that the Federal Reserve is now using in their unusual and exigent circumstances. So that's like not a good sign that's taken place here. I mean, if they have to expand these lending facilities to make them, more accessible, then that means that the economy is not turning around, but it's actually getting worse, and they have to make this more available. They're talking about the next stimulus package to come out of the government. Things are not going well. I mean, they wouldn't be doing these things if, there was a turnaround, if we were in a recovery. If you're in a recovery, then you don't have to perform all these stimulus acts. But when the patient is dying, then you have to stimulate it. And that's what's taking place right now. And you can see it from all the actions out there that are taking place. All right, I got to go back into work. Uneducated Economist, you guys let me know.